Well, I think what we've done for clients is we've taken an opportunity to rebalance. We did that a little bit ago. We expected some air pockets coming. You know, I actually talked to Rick Reeder this morning, a friend of the show and a friend of the team, and he had said on your show that rates were going to hit the 325 and we'd probably see an air pocket. And I think that's what's happening right now. You had, though, a report this morning that I think was pretty benign from a headline standpoint.
Wages rising as expected, right? 0.3%. The headline number missed, but there was the huge revision back in August. But what about the notion that, we seem to be in an environment, where the economy's great, inflation's tame, perfect environment, it seemed, for stocks, and now you have these rates rising. Jim, I'm wondering if that's now going to be a perpetual problem for the bulls.
Well, I think it's a problem today, Scott. I'm not sure it's going to be a perpetual problem.
Well, problem yesterday, problem today.
Yeah. And, look, we're at that 3.25 point on the 10-year that we've been talking about.
Years.
Yep. And the question is, where do we go from here? Because we're here now. And the S&P 500 is only 2% off of its high. So, 3.22 on the 10-year. Question is, where do we go from now? I have to say, look, first, let me say this, Scott. You know this. I'm third generation in this business. The first two generations are bond managers. They taught me not to predict interest rates. Having said that, I'm going to violate ancestral history and do that. Okay? Look, it's hard for me to see the 10-year going above 3.5%. Two reasons why. First off, take a look at German 10 years. They're at 0.5%. Take a look at Japanese government 10 years. They're at 12 basis points. It's just hard to get much higher from where we are here when there's those investment alternatives elsewhere.
The difference is, we've got a central bank that's on the path to raising rates.
I'm glad you went there.
And everybody else is sitting on their hands.
Glad you went there. They are raising rates. They're going to continue to raise rates. And it looks like they're going to raise once more in December, maybe 3 times next year. Gets them to 3 to 3.25 on the Fed funds rate. If you have a modestly steep yield curve, that gets you to 3.5, 3.75% on the 10-year. That's a year from now. If that happens gradually over the next year, the market, the stock market that is, will adjust to it just fine. That's why I don't think it
will happen gradually. Really quickly on that topic, and one of the reasons it's going to happen gradually is because of the deflationary impact that technology has had. We've been in an economy that is growing without an inflation impulse, and that is good news. It allows the Fed to be pragmatic and move at a much slower pace.
I think that can come to an end, though. If we look at 2019, one thing that we think is really not being factored into earnings estimates, because at the end of the day, corporate earnings growth is really what matters here in terms of driving the market forward.
Right.
If we look to 2019, we could get inflation coming from higher rates, higher wage growth, trade, potentially strong U.S. dollar, bad for corporate earnings, in addition to higher oil prices, potentially. So there are a lot of things that we contemplate whether or not these are really being factored into that 2019 earnings estimate.